Welcome back. Today we are diving deep into a really fascinating and, let's be honest, a highly contradictory event. We're talking about the fiscal year 2025 year-end earnings call for a late clinical stage biopharma company. This call on December 17th. It wasn't just a financial report. This was really the final and maybe sometimes painful confirmation of a complete strategic pivot.
It's fascinating because what you're seeing is a total identity shift for this company. Over the past year, they've been winding down everything, all of the legacy commercial operations, most notably that FC2 female condom business, to become a pure focused drug development house.
Right.
And that means, as an investor, as someone watching this, you have to just ignore all the historical sales metrics. They don't matter anymore. The whole story now is staked on clinical execution, managing a rapidly shrinking cash pile, and just hitting the timeline for their main drug.
Okay, so let's start with the financials, because that's where the contradiction really begins. The numbers themselves are, well, they're ugly. They confirm just how costly this pivot have been.
Yeah, they do.
For the full fiscal year 2025, which ended back on September 30th, net revenues just collapsed. They plunged 73.4% year over year.
Down to a tiny $4.485 million. And like you said, almost all of that is now classified under discontinued operations. It's basically a footnote.
And the bottom line just hammered home that challenge. They reported a total GAAP net loss of $22.7 million.
Which works out to a loss of $1.55 per share.
That's a huge miss from the street consensus, which was already looking for a loss, but something closer to 50 cents.
And when a company misses by that much, it tells you one of two things. Either the market's expectations for their cleanup were totally off, or the expenses for that cleanup were just way higher than anyone thought.
Yet, and this is the weird part, initially, the market seemed to brush this off. We saw pre-market trading show an initial pop, right? Something like 4.5% up on the clinical news.
Yeah, but that's where it gets really interesting. Despite that early pop, the stock closed the day down a sharp 8.61%.
On heavy volume.
On heavy volume, nearly 3 times the average. That reversal tells you everything. It tells you exactly where the market's real focus is. That little bit of optimism from the clinical data, it was completely erased by a closer look at the funding and the execution risk.
So the market is screaming caution.
It's screaming that it's worried about dilution and the long binary road ahead. They're focused on the clock, not just the science.
So let's talk about the science, because that's what drove that brief moment of optimism. The clinical thesis they're staking the entire company on is, well, it's genuinely game-changing. It's anchored by some really robust phase 2 data. They're positioning their combination therapy, that's enobosarm, an oral SARM, paired with a GLP-1 as the next-gen approach for obesity.
And the rationale for it is brilliant because it goes right after the single biggest problem with current GLP-1s like Ozempic or Wegovy. The FDA defines obesity as a disease of excess body fat. But the issue with these drugs is they're not selective. They cause indiscriminate weight loss.
Meaning you lose muscle along with the fat?
A lot of it. Patients lose weight, yes, but up to 50% of that weight can be precious lean muscle mass. And that's a huge problem, especially for older adults. The whole thesis here is about delivering quality weight reduction, getting rid of fat, but sparing functional muscle.
And the results from their phase 2B quality trial really seem to support this, specifically with the 3 milligram dose plus semaglutide. They didn't just meet the endpoint. They blew it away. A statistically significant 100% average preservation of total lean mass at 16 weeks.
100%. 0 lean mass loss. Think about that.
And it wasn't just a passive thing, right?
No, not at all. The combination actually enhanced the quality of the loss. It led to about 12% greater fat loss compared to placebo. And if you break down the composition of the weight that was lost, the enobosarm group was 100% fat mass and 0% lean mass. The placebo group, they lost a ton of muscle. 34% of their weight loss was lean tissue.
Wow. That statistic, the 100% fat loss, that's the whole moat they're trying to build.
That's the entire intellectual property right there.
And beyond just body composition, the functional data is just as critical. It speaks to the real-world impact, especially for older patients. They measured physical function using stair climb power. The combo treatment led to a nearly 60% relative reduction in the number of patients who had a clinically significant decline in that power.
And get this, semaglutide alone in the control group actually resulted in a measurable loss of physical function in just 16 weeks. This isn't just a number on a page. This is about preserving independence. Can someone still climb their stairs? Can they maintain their strength? That's what doctors and the FDA really care about long term.
And there was a maintenance phase, too.
Right, which makes this even more compelling. When they stopped the GLP-1 but kept patients on enobosarm alone, it cut the amount of weight they regained by 46%. And even better, the little bit of weight that was regained was 100% fat, the placebo group. They regained 72% lean muscle. It suggests a more durable change in body composition.
Okay, that clinical story is fantastic. But let's be skeptical here and pivot right back to that harsh financial reality. The market's negative close shows they're focused on the cash burn, not just the clinical hope. And this pivot has been expensive. The company burned through $30 million in cash from operations in fiscal 25.
And they ended the year with only $15.8 million in cash on hand. That's a huge disparity.
That really is.
And it highlights why they had to do things like sell off the FC2 business. That sale brought in $16.5 million in proceeds, sure, but they had to record a $4.1 million loss on the sale. That loss tells you they valued it higher on their books than what they could get for it in cash. It's symbolic of them just purging assets to keep the lights on and fund these critical trials.
Which brings us to the inevitable dilution. Since the fiscal year ended, they did a public offering, brought in about $23.4 million net. Absolutely essential, but it came at a big cost to shareholders. That, I'm sure, contributed to that big post-call stock drop.
Exactly. And management was very clear about the runway this buys them. They said this new cash is enough to fund operations through the critical interim analysis of their next phase 2B study.
Okay, so that's the timeline.
That is a timeline you have to anchor your mind to. That interim analysis is anticipated for the first quarter of 2027. Q1 2027. That's the financial and clinical deadline that dictates everything.
All right, so let's drill down on that. The entire focus now, the next major catalyst, is this phase 2B PLATEAU trial. The name says it all. They're targeting patients who have reached a weight loss plateau on their current GLP-1, citing data that something like 88% of patients eventually hit this ceiling.
And the study isn't just a shot in the dark. It's a direct response to very specific FDA feedback they got in September 2025. And this guidance, well, it de-risked the regulatory path in a big way by giving them two clear options for success.
Two shots on goal.
Two shots on goal. Option one is the standard one. Hit at least a 5% placebo-corrected weight loss difference at 52 weeks.
But option two is the really interesting one, the potential market-defining one.
It is. The FDA explicitly said that if the weight loss difference is less than 5%, approval could still be on the table based on a clinically significant positive benefit. Things like preservation of physical function or improved mobility. And that is clearly the path the company is emphasizing.
And during the Q&A on the call, they got into the study design.
They did. They're targeting about 200 patients who are older, 65 or older, and have a BMI over 35. This is a high-risk population that desperately needs muscle preservation. And they're only using one GLP-1 in the trial, either semaglutide or tirzepatide, to cut down on variability. They basically called this a mini phase 3. It's designed for one reason, to figure out whether incremental weight loss or that functional improvement should be their primary endpoint in the final pivotal study.
So this raises a really important question. Will focusing on these functional benefits in older sarcopenic obese patients become their key differentiator in a super crowded market? By targeting patients over 65, they're tapping into a massive, maybe less competitive market, the 44 million Americans on Medicare Part D.
Exactly. Functional preservation for that demographic could unlock a much clearer regulatory path, maybe an easier path with payers, than just fighting for scraps in the general weight loss population. It makes a lot of sense. They're hunting for a unique label. That's the strategic genius kind of hidden inside all this financial mess.
Okay, time for our final segment. We have to start with a disclaimer. This is strictly a thought experiment based on the call's data. This is absolutely not financial advice. Our outrageous but plausible trade idea leverages that extreme binary nature of the stock and the high caution the market's clearly showing.
Right. So the thesis is this. The market is currently crushing the stock down to its floor because of funding risk and that recent dilution. But the core science-preserving muscle to break a plateau is fundamentally sound. And crucially, the regulatory path is de-risked by that FDA feedback. We've got two big catalysts, the PLATEAU trial initiation in Q1 26 and the interim data in Q1 27. The stock drop reflects maximum pessimism about them getting there.
So if the market's pessimistic now, how do you structure a trade to capture upside if they execute, but still protect yourself from a catastrophic failure with the data in 2027?
You implement a modified catalyst straddle. You want to bet on the near-term execution. The company successfully starting that PLATEAU trial on time in Q1 26 should give you a relief rally. So you go long a small position of the common stock now. That's your bullish leg. But at the same time, you need catastrophe insurance for the science failing 18 months from now. So you hedge that whole position with a bigger position in long-dated, out-of-the-money put options that expire well into Q2 of 2027. It protects your capital if the science fails at the interim analysis, but it lets you benefit from any price appreciation from good execution news over the next 6 months. It's a structured way to play a highly binary event.
That was a tremendous amount of synthesis. So the key takeaways from this FY25 call are pretty clear. The financials confirm this necessary but very painful pivot to a pure drug development model, which is being funded by that heavy recent dilution. But all that financial pain is supporting a clinical future that's staked entirely on the Phase 2b PLATEAU study, which seems perfectly designed to answer the FDA's questions.
And that leaves us with this final provocative thought for you to chew on. Given that the FDA has basically handed them 2 clear regulatory pathways, is the biggest risk for this biopharma now the clinical outcome itself? Does enobosarm actually work as well as they hope? Or, considering that extremely thin cash runway, is the biggest risk just simple, timely execution? Can they get that complex PLATEAU trial started exactly on schedule in Q1 2026? Because that schedule, well, that determines the whole cash clock.
A great question to consider. Thanks for joining us for this deep dive.